Is it time to short the market? Obviously, it's that time of the month again, and I'm talking about the FOMC meeting. Just as the S&P 500 is making a historic rally, another one since the last one that we had in July, we are up 8% in the month of October. Where is this rally going to end? At what point can we open up optimal shorts? Energy is booming once again, up 30% in a month. The US dollar index remains strong. The 10-year yield faked us out, thought that we were going to see a significant drop in the yield. However, it is still holding strong. What is going to happen after Jerome Powell announces a 75 basis point rate hike? And there is still a massive liquidity problem in the Treasury market. Welcome back to this week's edition of TA Tuesday. I'm your host, The Traveling Trader. Always happy to host you guys. We're going to be talking about the markets, about the Treasury markets, what the Fed is expected to do, how that's going to affect the markets, how long this bear market rally can last, where can we open up optimal shorts, and stay to the end of the video where I give you some of the juiciest trade ideas you've seen. You definitely want to stick around till the end because I will tell you how I'm trading this. Let's get right into it. So as I said, the S&P 500 is continuing its melt up. Now, if we take a look, because this is TA Tuesday, we're going to be talking a little bit more about technicals here, and it's going to be less general, but obviously we'll talk about how fundamentals and technicals merge in order to give us a solid thesis. But looking at the S&P 500, this is the SPY. We are in a descending wedge. And for those of you that are fans of this channel, you know that this is the area that I've been targeting for a few weeks now. Follow me on Twitter, follow me on Instagram, where I post free financial content daily, and you'll see that this is a level that I've been talking about for a while. Now, this is a confluence level here. This is the resistance line of the descending wedge, and we have what's called the golden pocket. The golden pocket is achieved by pulling a Fibonacci retracement tool. And the golden pocket, as you've seen here, was really the end of every single bear market rally this year. And now we have a historic level at a psychological level at 400 on the SPY as well. So you have the psychological level of 400, the golden pocket, and the resistance of the wedge. And I'm hoping that we get to this level because, as you guys know, I really only like taking trades, especially large trades, when there is an optimal confluence, an optimal level of confluence there. And that is why last time I opened up a whole portfolio worth of puts on the SPY and on the triple Qs once we hit this level here. Now, I didn't ride this all the way down. I wish I did. I did end up exiting in September when we had a huge, almost 4% week. Still made a good amount of money on those. Wish I would have held them all the way down, but I didn't. And if you guys want access to all of our trades, our analysis on stocks, options, futures, our daily trade ideas, strategies, the Zoom calls with me, the day trading course, the options course, you get access to all of that. Link is in the description below. Hurry up because we just opened up spots for November. And once those limited spots are taken, we usually wait until the next month before we open up more. So what could make the S&P 500 get to this level? Well, this man right here, Papa J. Powell. What could he do to keep the rally going? Well, as you know, there's been all of this fake talk about pivoting. I did a whole video on this and why this is actually really misdirection. This is either misdirection or ignorance or a mixture of both. We were seeing a ton of articles coming out talking about a potential pivot. And for those of you that are not up to date with Fed lingo, a pivot means a reversal of the current monetary policy. So a decrease in the rates, which is never going to happen, not while we have surging unemployment. The labor market is extremely strong. We have surging inflation, the CPI, the PCE, none of these numbers are significantly dropping. So there is no impetus here for a Fed reversal. However, what could make or break the market here? So we will either, as of November 2nd, we will either see a decline from here to continue the next leg down, and we'll talk about the potential extent of the next leg down, and why, in my view, it's not as bad as some doom and gloom are projecting it to be, not from here at least. Or we can continue rallying before seeing another break continuing the next leg down. All of that will hinge on how Jerome Powell talks about the future. If you remember the last FOMC meeting when he came out guns a-blazing, he was extremely hawkish, wouldn't really give any sort of timeline for when the jumbo rate hikes, the 75 basis points or greater rate hikes are going to stop. Wouldn't really talk about a terminal rate. The terminal rate means the peak Fed funds rate at which the Fed will then stop, assess, and potentially pivot if need be, if a recession gets too deep or recessionary fears are too deep. And Jackson Hole, which happened over the summer, he was even more hawkish, right? So if Jerome Powell, and we will be live streaming on November 2nd, so please keep that in mind. But if Jerome Powell comes out and says, hey guys, look, this is going to be the last jumbo rate hike. We've done 3 back-to-back 75 basis point rate hikes. This is going to be the last one, 4th in a row, a historic rate hiking cycle, at least going back to the 80s. And now in December, we're going to do a 50 or a 25 or even pause and see where we're at. And here's what the terminal rate will be in 2023. If he comes out and says that, then I think that the market has impetus to keep on running. Remember that the elections are coming up too, November 8th. Every single midterm election going back to 1950, the S&P 500 was up 12 months later. We've never had a midterm election where the S&P wasn't up 12 months later. The average return after the midterms is 18.5%, the lowest being 4% back in 1986, the highest being 36% in 1954. Here is the graph on a larger scale if you couldn't see it on the page before. But remember, the midterms are coming up, and we've never not had a rally a year after the midterms. So in my view, this supports the thesis that if we can actually get past the hump of FOMC, and if Jerome Powell comes out and gives us an expectation, and I think he will, not because of of anything political. Remember, Jerome Powell is a Republican, not that that matters, but it's not like he wants to help the Democrats in this case. It's not like there's some plot to help the Democrats. Paul Volcker was a Democrat under a Republican president. So the Fed chiefs are supposed to be neutral when it comes to espousing their political affiliations. But because of this here, this story continues to develop. If you guys remember my video, I will post it here, talking about the bond market illiquidity. What are the dangers of an illiquid bond market? How it could affect every other piece of the financial system, how it can actually cause things to crumble. Because ever since we went off of the gold standard, really the backbone of the US dollar are treasuries. That is how the US government raises money. 1 is by taxes, 2 is by selling treasuries to Americans as well as foreigners. And these treasuries are backed by the full faith and credit of the United States. There is no gold standard. That's it. Our dollars are only based off of treasuries. So if there's illiquidity in the treasury market, just know that that is a huge cause for concern, as it can lead to other parts of the financial system crumbling, whether we're talking about overnight repo, whether we're talking about the credit market at large. Because remember, the treasury yields are what sets the tone for interest rates throughout our entire economy, whether we're talking about cars or houses or corporate debt. So this article just came out today, again, as of the time of this recording, that there's illiquidity in the treasury market. There's sort of a cry for help for the US Treasury to come in and buy back bonds, buy back older bonds, essentially act as a second central bank, because really the Fed is the institution that buys bonds, not the US Treasury. The US Treasury issues the bonds. However, we did have a bond buying scheme back in the early 2000s where the US Treasury did come in, buy old bonds, and that allows newer bonds to actually gain more liquidity, because old bonds are hard to sell because they're usually based on old interest rates. So this is the reason why I actually think it behooves the Fed and Jerome Powell to come out and be a little bit more dovish, not with what's going to happen on November 2nd. That's still going to be 75 basis points in my point of view. There's no other way there's no other way that it can be, but about what the future rate hikes are going to be. And if we take a look at this chart here, let me move my big head. Actually, let me pull out my mouse pointer. But this is the first time that we ever have the bond market drop more than the stock market in a bear market. This has never happened. Going all the way back to the 60s, the 20 plus year treasury bonds have basically tanked in comparison to the S&P 500. This is a huge dislocation, but also will provide a huge opportunity in bonds. Remember, when there are these major dislocations in the market and there are extreme fears being generated in certain markets, that is usually the opportune time to buy for the long term. So I will talk about how I'm looking to trade the bond market again towards the end of the video. You want to stick around to get my trade ideas. And some of those trade ideas will include how I'm planning on playing the bond market, both from a future standpoint as well as an ETF and potentially option standpoint as well. All right, so back to this chart here. Again, the 400 level on the SPY is my optimal time to open up shorts. Now, you guys know of people, and probably some of you might have done this yourself. A lot of folks took shorts probably from this range here and completely got shellacked, and now we're screaming that the market is rigged. However, it doesn't matter whether the market is rigged or not, because you could play any position you want. You could play a short or a long. It's just that some people chose to short at support, and I never short at support. You want to short at resistance and long at support in order for your trade to be optimal. Doesn't mean you'll be 100% right, but to give yourself an edge, that is when you want to short and long. So I would never dream of shorting here. I did short from here, as I said before, and those of you that are fans of this channel know that I took that trade. I ended up closing it early, even though for profit, but I'm not going to then revenge trade and try and short from support. I'm going to wait until the next opportune time and open up a larger position because there is a higher risk to reward from that zone. Now, do I think there will be another leg down past the lows that we just saw in October? Yes, I do. But how far is that going to be? I don't think it's as far as some of the doom and gloom merchants have been stating. You're seeing all kinds of comparables to 2008 or the dot-com bubble or whatever. The economy is actually fairly strong compared to 2008. We don't have an underlying credit risk in the same way that we did in 2008. I personally don't think this is like 2008. We know we are going to be in a recession. This is the most telegraphed recession in history. Probably only second to what we saw in the early 80s when Volcker was raising rates to 20%. We know we are going to be in a recession. So that part is already telegraphed. A lot of bad news is already priced in. What is not priced in is the extent of negative earnings. So as you guys know, we actually did not get the earnings season that we really wanted. Alphabet, Amazon, Microsoft, Apple did okay on earnings, probably the only one out of the mega cap tech stocks, but we did not actually get great earnings and the guidance was even worse. So if we continue to see that quarter after quarter, then I think we will get what's called earnings compression. I think we are done with the valuation compression or the multiples compression that has already hit the market. So even if you look at meme stocks, right? If you look at like Teladoc and Roku, these stocks that we're trading that are down 80, 90%, those valuations have already crumbled. And a lot of the mega cap stocks have already seen, a 20, 30, 40% decline. However, what's next is earnings compression. So the market makes these companies pay in terms of valuations, and then it assesses whether the economic landscape is going to crush their earnings or not. So if we do get earnings compression, I do think that we still have a little bit more downside to go. For me, as you guys know on this channel, if you've been watching the TA Tuesdays, TA Thursdays, I've always been targeting the pre-COVID highs as the next major point here. So if we do end up seeing a rally after FOMC, after the election, I do think that on the next leg down, we will finally hit those pre-COVID highs on the indices at least, especially if the US dollar index continues to be strong. We've been holding this trend line since the beginning of the year, since January, really. And we haven't bucked this trend. And there's no reason to think that we will, because this is the US dollar in comparison to a bunch of other strong financial currencies or currencies of strong financial markets like the Japanese yen and the British pound. And those markets are still doing quantitative easing, right? They're bond buying in England. They are bond buying in Japan. People's Bank of China is doing a bond buying program now, right? The Central Bank of the United States is one of the only central banks of the major financial superpowers that isn't bond buying and is actually doing quantitative tightening, although it looks like, we might be instituting some sort of bond buying here if the Treasury agrees to this. But as long as the US dollar is strong as well, that's going to diminish the earnings and the discounted cash flows of our mega cap companies. However, here's why I don't think it's all doom and gloom. If you take a look at every single recession going back to the 50s, and I want you to look at this dotted blue line. This dotted blue line is the S&P 500, right? We have GDP in gold, payrolls in dark blue, and we have earnings in red. The market is forward looking, right? That's why sometimes you get questions from newbies talking about, why is the stock market rallying with all this bad news? It's because the stock market is forward looking. So if there's an indication of things to come that are parts of the major financial system, this guy is definitely one of them. So if he gives us an indication of what's to come with regards to yields, with regards to rate hikes, with regards to unemployment, then I think the picture will be a lot clearer. And you could see that the S&P 500 rallies almost every single time. The S&P 500 bottoms and starts its rally way before other things in our financial system, other major factors in our financial system, in this case, GDP, payrolls, and earnings, have bottomed, right? The S&P 500 bottoms and starts its rally way before the GDP bottoms, way before payrolls have bottomed, way before earnings have bottomed. So this is why, even though I do believe another round of earnings compression is coming, is going to hit the market and potentially take us down at least to the pre-COVID highs, I don't know. I'm not saying this is the bottom, but that is definitely the next major point that I will be looking at, and we'll definitely be buying more stocks at that level. And I'll talk about what I bought up until now. But this is why things don't have to bottom and likely will not bottom before the stock market gets better. Here you have the global financial crisis of 2008. Here you have the pandemic, which was the biggest joke of a bear market ever because that lasted 5 minutes or so. And the same thing is going to happen here. We're not going to see a full-on earnings compression bottom out and then earnings get better before the stock market actually start to rally. We will likely see, if Papa J. Powell gives us an early Christmas present and telegraphs a little bit of what's to come, we could see a rally, another drop, and then potentially once the earnings picture right before it starts getting better, right? Then we will likely start to see a rally. And I think this will also coincide with the inflation picture getting better. However, we will not truly bottom until the Fed is done with hiking, or at least the Fed says that it's going to be done with hiking on a certain day. Because remember, inflation is still above 8% year over year, and the Fed funds rate right now is under 4%. So the Fed funds rate has to go above the CPI for the Fed to have considered its job done. So inflation does have to start coming down, and the Fed funds rate has to keep going up. And they're looking at a 5% terminal rate for 2023. If in 2023, maybe late 2023, inflation is finally at 5% or 4%, then I think that is when the market will get another boost and potentially find an absolute bottom of this bear market then. But don't get it twisted that these things have to bottom out perfectly for the market to rally. That has actually never happened in history of recessions. The one thing that scares me about this whole ordeal, really, and I'm not just saying this to make this video exciting. The one thing that scares me is the Fed balance sheet, because this is something that has actually never been factored ever before. So the Fed balance sheet, this quantitative easing was something that we tried. It was a full-on experiment after we were desperate. The 2008 crash, we added $2 trillion of assets on the Fed balance sheet. It seemed to have actually worked, right? And then for some reason, that balance ended up doubling between 2012 and 2015. That balance sheet ended up doubling. So it became $4 trillion, right? Then in 2019, the Fed actually tried to do quantitative tightening. And I want you guys to look at something. If you look at the definition of quantitative tightening, I want you guys to look at something. It says in 2018, the Federal Reserve began retiring some of the debt on its balance sheet, beginning quantitative tightening. QT has never been done before on a massive scale. Never. Okay, so this was an experiment. In 2019, less than a year after initiating QT, central banks, including the Federal Reserve, ended quantitative tightening due to negative market conditions occurring soon after. That's it. That's where it ended, right? So this is something that scares me a little bit because we actually tried it here, right? This is the dip in the balance sheet that you see, which was a joke compared to the amount that's fully stored on the balance sheet. We tried it and the Fed got scared. And this is actually when President Trump at the time had scolded Jerome Powell publicly and told him to stop. Jerome Powell caved in and stopped. Obviously, we didn't know that what was coming up on the horizon, the pandemic. We didn't know that the pandemic was on the horizon. So the Fed actually did not have a chance to try full-on QT before the pandemic came, and we were forced to then do more asset purchases. And now the Fed's balance sheet doubled again, went from 2 trillion after the financial crisis to 4 trillion. And then from 4 trillion after the pandemic went to 9 trillion, right? So that is the one thing that scares me here is this right here is the, what do they call it? This is the X factor because we've never, ever done QT. QT has never been done before on a massive scale. So that is the one wrench here that can really, if the Fed is serious about this, this is the one thing that can actually throw a wrench in the length of the recession, right? Because it's something new. So you see here the black line is the S&P 500. The blue line is the Fed's balance sheet. We need the Fed's balance sheet to drop in order to curb inflation, right? Because remember, this is one of the ways that the Fed actually injected money into the system is by buying assets from banks. That's where it picked up all of these treasuries and added it to its balance sheet. And in return, it gave the banks the money. And because rates were so low, the banks then loaned that money out to people and businesses. That is how money printing actually works. It's not like they're printing money on a Xerox and then just throwing it out from a helicopter. They're buying assets from banks, giving them money that doesn't exist. They just, a few keystrokes, and the banks all of a sudden see a new balance in their account the next morning. And then the banks can then loan that money out. But because interest rates are so cheap at the time they can loan that money out for very cheap. And that's how money makes it into the economy. That's how fake money makes it into the economy. So in order to rein in that cash, the Fed actually has to sell assets off of the balance sheet and take some of that liquidity out of the system. And this has never been done before. So the process of doing that in order to fight inflation, obviously, if the stock market went up because of QE, the stock market will likely follow QT and tank as the assets are rolled off of the balance sheet. Now, obviously, the Fed can come out and say, you know what, we're done. Like they can focus on the rate hikes. Inflation comes down. Inflation is now below the 5% terminal rate that it's going to be at in 2023. The Fed can actually come out and say, you know what, we're done. We're just going to keep these assets on the balance sheet, kind of how they did after the 2008 financial crisis, kind of how they did after 2015. Really, who knows? I would not be surprised whatsoever. So to me, this is the X factor here. Now, in terms of trades, here's what I'm expecting. If the Fed actually comes out and gives us an indication of what's to come in December and later, then bond investors will feel much more comfortable buying bonds here. Because what is the real cause of, where is it at? Where's my chart at? What is the real cause of this, right? What is the real cause of the bond market tanking more than the stock market? Is because there is no liquidity in the bond market. Bond investors are not wanting to tie their money up if they still think that inflation is a problem, if they still think that the Fed is going to hike rates into oblivion with no end in sight. Then there's no reason for them to tie up their money in a fixed income that only pays, say, 4% when they expect that bond to pay 5 or 6% in the future. That is why we don't have any buyers in the bond market. However, the Fed comes out and says, this is what our terminal rate will be. This is when we're ending. This is when we're potentially pivoting. You'll see a bunch of bond investors pour into bonds and hopefully buy up bonds to drive these yields down to this trend line here. This trend line, again, just like the Dixie, just like the dollar index, this trend line has been established since January, right? So if we're expecting rates to go down, what does that mean for bond prices? Remember, when bond yields go down, bond prices go up and vice versa. So if we're expecting bond prices to go up after the FOMC meeting at some point, then there are a few trades you could do here. TLT, which tracks the 20 plus year treasury bonds, it's an ETF that's made of a basket of 20 plus year treasuries. This one will start to gain. And if you guys are followers of this channel, you know that we bought TLT calls last week. Those are up 70%. But once the Fed gives an expectation of when they're going to stop, TLT is actually going to start rising again. And just to give you an extent, to show you the extent of how much TLT has crashed, this is TLT since 2020. We went from a high of about 180 to now trading at 96. Obviously, you could play calls or puts on TLT. If you're expecting TLT to rise, you want to buy long dated calls. But TLT is getting down near historic lows here, right? Going all the way back to 2002. So in my view, after this FOMC meeting, especially if Jerome Powell, you want to watch for what Jerome Powell says. And remember, we will be live during the FOMC meeting. I will likely be buying another round of long dated TLT calls. I will also likely be buying some TLT because it is, at the end of the day, a dividend paying ETF. And if you're looking to have a barbell strategy, which is a mix of bonds and stocks, and you want some bond exposure, whether that's 20% bonds, 80 stocks, or 40, 60, TLT is a good and liquid ETF to hold on to. Also, from a future standpoint, ZN, Z like zebra, and like Nancy, the ZN is a futures contract that is based on bond prices. So there is one, ZN tracks the 10-year T-notes, right? And currently, again, these bonds have also crashed because this is based on the 10-year. The 10-year has been rallying. The 10-year yield has been rallying like crazy, which means that the 10-year prices have been tanking. But you can also buy ZN futures if you expect the 10-year yield to drop and the 10-year prices to go up. And again, if I'm expecting this to happen after the FOMC meeting till at least this trend line, then I will buy longs on the ZN futures. I've been really strategically buying here. So if you guys have been following this channel, you know that XLE was one of the only major stock purchases we've made recently. This is the energy sector of the S&P 500, up 30% since we bought in last month. This was also sent out in the Academy. I initially bought this for the 4.4% dividend yield and the fact that I didn't think the shortage of oil, that story has ended, especially with what OPEC has been doing. And also there was bullish divergence, hidden bullish divergence between the RSI and the price. And the volume profile showed me that the point of control was actually above $77. And at that point, this was trading at $70. So that is why I bought XLE. Ended up climbing 30% in a month, something that I didn't expect to be rising at that rate. But hey, I'm not going to argue with it. So I will likely be buying TLT at some point soon, and then we'll add to my S&P and QQQ positions if we do end up hitting these pre-COVID lows. I ended up buying some S&P and some SPY and some QQQ at the bottom here once we spent 3 or 4 weeks at this level. But the next round of buys will likely be at the pre-COVID highs. Anyway, traders, that is it for this video. If you want access to all of our trades, our plays, our ideas, if you want access to the chat with thousands of traders where we talk about strategies, We talk about tutorials all day, every day, how to chart, how to trade options, futures, etc. Link is in the description below. You also get access to the day trading course, the options course, the Zoom calls that I do with the group every month. Sign up. Spots are going to go fast in November because they always do. If you got anything out of this video, hit that thumbs up. Leave it in the comment section below. Let me know if you started to buy, what you were starting to buy. When are you looking to buy? What do you think is going to happen with the market, etc.? Would love to hear from you. Try to respond to each and every comment. Stay safe out there, traders. Peace.